Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The seniors all hit new highs during the week, but will that trend continue with interest rates inching higher and Bitcoin showing no signs of slowing down? Discovery Watch's John Kaiser from KaiserResearch.com has a special offer for our listeners. He comments on the so-called PDAC curse and whether the COVID crisis could set up another version of the roaring 20s when it comes to investment. Veteran trader Victor Adair tells us why the NASDAQ has lost a bit of its shine. He talks about bonds, the US and Canadian dollars, gold, and crude. Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money, Ross.
Always good to be with you, Jim.
Ross, did we see more record highs on the senior markets?
We did at various times during the week, and various items settled back. On Friday, it was Visa was hurting the Dow for the first time in, about a week and a half? The Dow has been the real leader here on the upside the last little while, and Friday finally gave back a little bit. But, the S&P looking pretty good, the Russell, and even the NASDAQ, the triple Qs, had a pretty good recovery at in the middle of the week, but looks as though that basically the rotation that was out of the high-tech stocks, that's still continuing, and we're seeing the strength over in other sectors. Now, one that did have a pretty big reversal was the energies. At the early part of the week, I guess it was it was on the weekend, we had written up that the exhaustion figures that we look for at extremes as far as markets are concerned were showing up in crude oil on the weekly chart, and also in terms of gasoline prices, which have had just a dramatic move. We've saw gas up to about $2.15 in terms of wholesale prices, and looks as though from a seasonal perspective, you usually see a high in March or April for gasoline, and the type of run that we've had. You've had maybe half a dozen of these in the last two or three decades, and each one of them had a good, solid correction. I would expect that gasoline might give back maybe 40% of the rally that's had from October, and it's so overbought it may even give back 40% from this time last year. But we'll see what happens. The whole complex there, as far as energy is concerned, was in need of a breather. And, I think you might be looking at the XLE as far as the U.S. ETF is concerned. A little bit oversold on Friday, ready for a small bounce, but I'd say in the next maybe 2 weeks or so, you could be looking for a corrective low to be picking up some of those energy stocks.
What's going on with the U.S. and Canadian dollars?
Canadian finally starting to pause up here. We've ended up with the Canadian a pretty good run into the early part of the week with commodities, with the oil market, but and with interest rates the way they are right now, the move has been positive for Canada, but we're seeing on a monthly basis this 80-cent level here, maybe 80 to 81 and a half, is pretty big overhead resistance, and the monthly numbers would show that This is probably a long-term base going back to 2015, but in need of a bit of a pullback. It's been pretty much an uninterrupted run for 12 months here. And if we could have a month or two of a pullback, maybe towards the 76-cent level, that I would view from a long-term perspective as extremely constructive for the Canadian dollar. So short-term, vulnerable, longer-term might present a pretty good opportunity as we move maybe closer to the summer or into the summer.
Is there pressure to bring on higher interest rates?
Oh, without a doubt. I mean, you've got, we're seeing the open market rates. If you look at the 10-year rate on the treasuries, we've gone from 50 basis points up to 170 in this move. And a lot of talk of, because we've had this big move in commodities, that the Fed should be tightening on the short end, which is the only place they can. Whereas when you see the open market rate, they have had that move already. But with the Fed talking about keeping rates down pretty much indefinitely here the next year or two, that's going to have a negative impact as far as the U.S. dollar is concerned. But I think that when you look at the longer term rates, the implication will be that the U.S. dollar we'll be looking at this as a base when we look back a year from now, and probably looking at higher levels as we move down the road.
What happened with gold?
Gold, it's been a pretty nice run. We got a capitulation low just over 2 weeks ago when it was down at 1690. Had that first pop into 1730, back to 1700, and then this week continuation back up. So closing off the week in the 1740s. And we don't look for this to be a long-term rally. The overall picture for us is that we want to see maybe resistance from up to maybe 1770, and from there initially back to retest the lows, but wouldn't be a tall surprise if you got into the mid-1600s. When you take a look at gold and silver, they have really underperformed the commodity indices and the oil market on this big rally that they've had. And when we've seen that historically, it's meant that we need some deeper oversold levels in gold and silver and in the miners than we've seen this year. So I think this is just a bit of a reprieve rally right now with more to be seen on the downside.
Any comment on what's going on with Bitcoin?
Bitcoin, we've seen that as a really nice uptrend, and the last corrective low there at 44,000 for us was a great entry signal on the most recent run. The trend is still well in place, and here we are just shy of 60,000. I think as long as it manages to hold 48,000, which would be, I think, probably the deepest correction that I'd allow for right now, as long as that's in place, our target at 120,000 is still in the cards, and that's when we take a look at the big patterns. You'd look at the rally we had into 2017, and then into again here. The style of run, there's probably an exponential move still to be had in this one, and so you stay with the trend until proven otherwise. And at this point, if this pause around this 58 to 60,000 level, I think is acceptable, and don't fight it.
Ross, do you have any special offers for our listeners?
Well, we have an offer that will be for $200. The They can sign up for a subscription that will take them through the end of May, so 2.5 months worth, and give them the listeners the opportunity to review our material, and if they really like it, they can come on board for a full annual subscription.
Ross, thank you so much for chatting with us.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can also find him on Twitter at ChartsByRoss. Coming up, John Kaiser, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Kaiser. He's a weekly guest on HowStreet.com radio with his show Discovery Watch. He's speaking to us from California. John, welcome back to This Week in Money.
Jim, thank you for having me on This Week in Money.
John, do you have any special subscription offers for our listeners?
Jim, I have a different type of deal, not the normal one. KaiserResearch.com serves 3 distinct audiences. One are favorites seekers, people who want to hear about my 30-plus top picks. Another group is the do-it-yourself researchers who love the fact that Kaiser Research is also an information portal that covers 2,300 resource companies listed on the Australian Stock Exchange and the Canadian Stock Exchange with a very powerful search engine. These people don't care at all what I have to say about particular companies. They know what they're looking for. They're very sophisticated. They think it's very funny that I only charge $450 per year for access to this research platform. The third group is my original audience, bottom fishers who are looking for companies that have some missing piece to them that don't really qualify for a formal, full-fledged recommendation in the resource sector. Right now I have about 200 bottom fish spec value rated companies in the system. There's something wrong with all of them. And I've developed something called a Slack workspace, which is like a private forum for KRO members where we collaborate, where we have different channels. We research this stuff, and the direction that I'm going, because this is a website that's over 15 years old, so it's somewhat rickety. It needs to be placed. I will be spinning out the favorites as a traditional stock picker website sometime later this year, and then turn the current research.com platform into an invitation-only type system where the do-it-yourself researchers do their own thing, and the bottom fish workshoppers, they continue to, get my comments about what's wrong with these companies, what's falling into place. And this bottom fish workshop becomes like a farm team for future favorite recommendations. And the deal is that if you sign up now for the $450 membership, you'll get all 3 of these for now, and you'll have a chance to stay on with the Bottom Fish Workshop Do-It-Yourself Research Platform when I spin out the favorites as a separate entity. And the favorites, this year we've got 30 in it. They're up 14% already. Last year's collection of about 35, it is now up about 136% from the start of 2020. It finished the year up 98% and had a top peak of 102%. And what we do every year is we roll over the ones that we still like, that we believe still have upside, and then add new ones. And during the year, we close out some that we think their story's falling apart, and we add new ones that come along, often graduates from the Bottom Fish Workshop. So the deal is get in now so that you have grandfathering rights to be part of the the Bottom Fish Workshop do-it-yourself research platform after I launched the new favorites only website.
John, the annual International Mining Conference called PDAC, Prospectors and Developers Association of Canada, which usually meets in Toronto, just completed a virtual convention of itself. In most years, the resource juniors head south in the second quarter of the sell in May and go away dictum of past decades. How did the juniors do ahead of the PDAC conference, and what do you expect afterwards this year?
Well, this year the juniors had one of the best openings at the beginning of the year. The first week of January was tremendous, but the juniors were tracking the uptrend in gold. And after the Capitol Hill assault on January 6th failed to overthrow the government, it seemed like all the oomph in gold going up went down. Gold has lost, the GLD ETF has lost almost 4 million ounces since the start of the year. It managed to get about to 39 million ounces at the end of, at the end of last year. And that's down from the sort of 43.5 million peak achieved in late 2012. So every day people have been pulling money out of the GLD, and gold, which was trying to get back to $2,000 at the beginning of the year, is now around $1,700. So the first 2.5 months of the year did not quite have the January effect that we normally see during the first quarter ahead of PDAC. Now, the thing that they call the PDAC curse is the tendency for the industry to get all worked up in the first quarter. We got a brand new year ahead of us, and the big gathering in Toronto where 30,000 people from around the world gather. It's a celebration of the industry and the optimism about metal prices going up, exploration discoveries going to be made. But there's this other thing in the resource sector called sell in May and go away. And in the past few decades, what has happened is the market has learned this and has decided to be smart. It's sell during PDAC and go away, and hopefully come back in September when the results of the year's exploration programs start to roll in. So almost inevitably, the resource juniors sag in April through June, and then kind of just go sideways in the summer while we wait for some surprise news release. The exceptions have been 2003, which was the awakening of the China super cycle. The next exception was in 2006 when the mining companies who thought China was a flash in the pan finally got it and stopped hedging all their production, forward selling all their production. And then the next one was surprisingly in 2009, after the 2008 crash, and everybody thought everything was dead, and the resource juniors launched on a 3-year run that basically stalled in March of 2011 when Fukushima came along and sort of ended the whole uranium sector's hopes, and gold still managed to get to a peak in August 2011, but it descended after that. 2010 was the key year that the Republicans gained control of the House, and austerity became the fiscal policy response. All we had was quantitative easing. We had an exception in 2016 when it looked like gold was ready to go up again, and we had a great 8 months for the resource juniors. We blazed right through the PDAC curse. There was none. But then that hit the wall again, and the cannabis and Bitcoin stuff took over, and it wasn't until this last year in 2020, at first we had the huge meltdown the week or so after PDAC related to the sudden realization that COVID is real and everything locked down. But then we had pretty much an unrelenting uptrend. It did stall in August when gold stopped going higher. But in general, the resource juniors have turned around from that 10-year bear market that began 2011. And although we did not see huge gains except in specific sectors like lithium, we did see a very strong financing window during this period. And that's something to keep in mind, is that the financing has turned around. From May onwards, the juniors are finally raising money through private placements, and even these bought deals, which are done with short offering memoranda that allow the stock to be free trading. We're still not anywhere near that window from mid-2010 to mid-2011, which was the ultimate financing boom for resource juniors. But we are looking at a future that is very promising. Gold at the moment is a bit lackluster because the inflation still hasn't really happened. With the departure of Trump, the uncertainty that worried people and got them to buy gold has disappeared. The $1.9 trillion bill, it's really more a recovery bill flowing a lot of capital to the 99% to give them some spending money. That won't result in inflation until later in the second half. And the real stimulus that we need, the fiscal stimulus that goes into capital investment, infrastructure renewal, that has not happened yet. Trump promised it in 2016. His party did not let him deliver on any aspect of this. That sort of renewal of infrastructure, that has the tendency to boost inflation. So gold's still languishing because we're not seeing strong evidence of inflation yet, but other metal sectors are starting to do well. The base metals and the critical metals, anything linked to the clean energy trend, which is now, regardless of who ends up in charge of the United States in 2024, the clean energy trend is now in place. The shift to the electrification of the transportation sector, that's now basically unstoppable because industry itself has embraced this trend. So I think although we had kind of a weak start to the year for the resource juniors, I think we will start to pick up steam. The PDAC curse will be violated this year in the second quarter, and with the vaccine rollout doing especially well in the United States, we're going to see the people start spending all this money they saved up during the past year because there was nowhere to spend it. They're going to go on a spending binge. There's going to be this celebration of existence again, and I think we will see the demand for raw materials go up. And because the mining industry during the past decade did penance for its excesses during the China supercycle, didn't really mobilize a lot of new supply, and there has been this end times mentality hanging over everything, that we're really at the end of a civilization. The boomers are going to turn the lights out in 20 years. The post-boomers have no real clout in anything. Climate change will sweep in and alter the entire planet and put us back into some sort of dark age. We're in an inflection point, and the whole COVID thing, it's setting the stage for a roaring 20s type of scenario. I've been tracking the Dow from the 20s and the Dow from the 2010 decade, and it's been remarkable, this sort of uptrend that they have manifested with the sharp upturn in the last couple years, and then the sharp reversal. In the 30s, the Dow ended up, after the V-shaped recovery, tanking and bringing in the depression period, which lasted 8 years. But with the current situation, yes, the markets are frothy, they're way up, but maybe it's like at the beginning of 1920, after the devastation of World War I and the Spanish flu epidemic that killed 50 million people. The stock market did not do tremendously well during the first 7 years or so of the decade. It trended up nicely, and we may see the same sort of thing going forward. There might be a modest correction, but then we'll see the value stocks come back into vogue. The people will start focusing on the rebuilding and the growing of the economy beyond the trends that were in place beyond. And all of this is going to be intensive for raw material demand. The juniors are positioned to find new deposits, to demonstrate the feasibility of existing ones as real metal prices rise. And inevitably, this type of boom will cause inflation to creep back in and bring gold back in vogue, and we will get it into that $2,000 to $3,000 range, and in real price terms, in the not too distant future, where all the gold exploration and feasibility demonstration juniors all kick in well. So I think we're going to have a good year going forward for the resource juniors.
Well, J.P. Morgan, I think, agrees with you. They say small and mid-cap stocks are going to outperform the major stock markets, not just for this decade, but they say for decades to come. So J.P. even agrees with you.
The point is the smaller subsectors is where the money's going to go. The broader indices, they'll become kind of boring. And of course, in the last while, it's been going into crazy things, things related to battery technology, abstract stuff with fintech, and so on. But the sector that I'm particularly interested in is the raw material supply sector, the stuff needed to make things actually happen rather than just entertain oneself. And yes, this subsector is one that's going to do extremely well, even though the broader market kind of just putters along in a modest uptrend.
Bitcoin and other cryptocurrencies have done well in the first quarter. Some say Bitcoin is the new gold. Others say Bitcoin is the new money. You say gold is not money. What do you think Bitcoin is?
Well, Jim, first to explain, money, in my view, is an information system that keeps track of debits and credits over time, space, and agent to facilitate market exchange, to facilitate a market. And the existence of money also serves as a price discovery mechanism so that you can say this service is worth so much and that service is, and that good is worth so much, and the underlying exchange, the barter system, uses money to lubricate itself. Now, this is an abstract system that really should not have any significant cost to bring itself into existence. And that's why I do not regard gold as money. I regard it as a special asset class. To take it from its dispersed form in the earth, you need to inject energy in terms of extracting it and concentrating it into a bullion bar. And once it's above ground in bullion form, gold represents stored energy. You want more gold, you're going to have to inject new energy to extract it from the ground. And people use it as a sort of an insurance policy. There's $12 trillion worth of gold sitting in vaults around the world. And that's the reason gold is kind of sluggish in terms of its market trend, because there's a lot of gold out there potentially waiting to be sold to convert into money, which can be then used to buy other assets or goods and services. Bitcoin is a different creature. It is a digital construct that really refers only to itself. I liken it to some OTC bulletin board company which has a limit of 23 million shares that can be issued. And what it does is it trades in a market in dollars. So it's a parasite on the actual currency money system. It isn't really used very much to exchange goods and services, except for narcotics and the ransomware payment that you need when hackers shut down your computer. It's quite inefficient in functioning as money, and it costs energy to maintain. Every time a transaction, an ownership transaction is done, a problem gets dumped into the system, and all these computers around the world race to solve it. And whoever solves it and submits the solution, they get an incremental Bitcoin, and they call this Bitcoin mining. And as we get closer to that 23 million limit, the Bitcoin that you get will become tinier and tinier and tinier. But right now, Bitcoin's around $60,000, and if we reach that theoretical limit of 23 million Bitcoins, $500,000 would be the equivalent value of all the Bitcoins to match it to the value of gold right now at around $1,700. So the idea that Bitcoin will replace gold as this new asset class, that has a lot of upside momentum in it. And as far as I'm concerned, it's really a Ponzi scheme because this Bitcoin doesn't really refer to anything. You pull the plug on all those computers and it just vanishes. You lose your digital wallet and that Bitcoin stays in the ether forever. Unlike the gold, somebody will break open your safe and extract the gold and redistribute it. The Bitcoins can all just vanish. Now, a lot of people are negative about Bitcoin because it serves no useful purpose. It's just a gambling mechanism pulling in momentum money. And groups like Citibank, the financial sector, they're starting to promote it. Oh, this is a great asset class. You should convert your capital into Bitcoin. It could keep going and going and going. You'll get rich. And every month the Federal Reserve buys about $80 billion of bonds, which buying pressure pushes the yield way down. And people with capital who sell these bonds end up with, $80 billion of money in their pockets that they have to put somewhere. And if we see a massive movement of capital going into Bitcoin, well, somebody has to sell a Bitcoin for a new owner to own a Bitcoin. And the early owners of Bitcoin are going to have been a much more adventurous group of people. So if we do see Bitcoin continue to inflate in value as all this money comes in from the sidelines, what is the current Bitcoin owner going to do with that money? Are they going to buy more Bitcoin? No, that makes no sense. Are they going to buy those 1% yielding bonds? No, they are probably going to invest this money in interesting ideas. Some of it they'll spend maybe buying an island in the Caribbean and a yacht and stuff like that, but there's only so much physical stuff that you can buy. So this movement of capital, stagnant capital that just sits there in these bonds, moving into the pockets of adventurers who have an extraordinary windfall, this could end up being a huge stimulus of capital flowing into sectors, R&D, innovation. So even though one can say Bitcoin is a scam that will one day collapse, all the money that flows in actually flows out into the pockets of others who are going to use it to stimulate the real economy. So it's not necessarily a bad thing that Bitcoin exists.
The interest in Bitcoin is one indication of market irrationality, but there are many others, some of them affecting segments of the juniors. Where do you see this going?
The problem created by the lockdown was that people had a lot of time on their hands and they did not have much ability to spend money. And with trading platforms like Robinhood coming online, and then labeling people to even buy fractions of shares, this has opened up the stock market to the post-boomer audience, people that are younger than 55 years, people down to the Gen Z, the people who are under 25 years of age. And of course the millennials are now the big force out there. And this has fueled a lot of momentum in the market. Tesla itself has an extraordinary market valuation, all based on the idea that in the end, the Tesla electric vehicle will be the winner that takes all. In reality, Tesla's a tiny company with a very big market valuation and an excellent product that is showing the way for all the other car makers as to what they need to do if this trend towards the electrification of the transport industry continues as it has been. I mean, Volkswagen is suffering from its Dieselgate scandal, where it used software to tamper the tests, the smog tests, showing how well their pollution control devices worked. And this has become that crisis that became the mother of invention. They are shifting now completely to electrification of their future car fleet. And they are the biggest producer in Europe, the second biggest in the world after Toyota. GM has said that it's shifting to will not be selling combustion engine type fossil fuel cars by 2035. So everybody is shifting in this direction over the next 15 years. So this creates an arms race, an R&D arms race for what is going to be the battery that ends up being the standard battery, like the boring lead acid battery that's in every car today. And there's dozens, hundreds of varieties under development, and none of them really fulfill the 4 key criteria, which is 1, is it safe? 2, can you charge it up as fast as you can fill your tank with gasoline? Will it give you the same driving range as your car with a full tank of gasoline? And can you accelerate the way you can with an internal combustion engine? And getting all 4 of these to work. And of course, the 5th thing is, can you is there a recharging station, almost anywhere, within 5 minutes of driving range, as opposed to finding some one every 10 miles, or finding a place to plug into your apartment parking lot type of thing. So these 5 things all need to come together. And this creates tremendous opportunity, speculative opportunity, because any of these technologies out there could end up being the one that ends up being adopted as the basic battery pack for all these future electric cars. And then all the other things become sort of the bells and whistles which the consumer ends up focusing on. And in this regard, Tesla is way ahead of the curve in coming up with interesting things, interesting features for its cars. So in this climate of capital available, of people thinking about future things and moving into companies that end up being that are smaller market cap, like the GameStop phenomenon was one that we saw in a month and a half ago. That creates irrational valuations, and it ends up creating momentum-driven trading. And so you have the money roving in from one uptrend into another one, and it creates tremendous volatility for this system. I think the whole clean energy idea, the transformation, I think it now has staying power, and I believe that we will continue to see irrationality in the market. It won't be a total broad-based irrationality. It'll end up being company-specific or sector-specific, roving from one idea to another. And that isn't necessarily a bad thing. It's when the entire market goes to the moon, that's when you know it's over. But when the irrationality is roving within a strong market system, that's actually a good thing.
We'll have more with John Kaiser when This Week in Money returns.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Kaiser. John, is uranium considered clean energy?
When you define clean energy as energy generated without the production of carbon dioxide, that or even like a methane gas as a leakage, that, and in other words, doesn't contribute to global warming, then uranium certainly qualifies as that, because the carbon footprint of mining uranium is quite small relative to the amount of electricity that a nuclear power plant generates. And uranium is something that the left has never been particularly happy with. One is because uranium, as the reactor fuel, also facilitates the production of weapons-grade uranium for nuclear bombs. So proliferation is a big problem. If they'd used thorium back after the World War II to build power plants, and you can't make any weapons out of thorium, it would be a different story today. But the other problem is the radioactive waste disposal, and they still really don't have an efficient method of dealing with this. The footprint is relatively small, so you can continue to store it. And the risk of an accident, a meltdown like Fukushima when the tsunami hit it 10 years ago, that freaks out people. When Fukushima happened, Germany pulled the plug on nuclear energy and ironically shifted to coal-fueled electricity and contributed to global warming in that way. Japan still hasn't properly restarted its nuclear energy sector. And so the uranium sector has been in a bit of a, 10-year bear market. And part of the problem is that the utilities, which stockpile uranium fuel in advance of needing it, they have been busy selling it into the market, which has depressed the spot price, and it has also lowered the long-term contract to the point where Cameco, which shut down its McArthur River mine, the richest uranium mine in the world and in the Saskatchewan's Athabasca Basin, because it was cheaper for it to go in the spot market and buy uranium and deliver that to fulfill its long-term contracts, preserving the ore in the ground for a future when this utility stockpile has been depleted. Now, the enthusiasm right now for uranium as a clean energy solution, this has caused a lot of interest in uranium stocks, even though the prices for uranium are still very low, and the timeline to approve and develop a new nuclear power plant is quite lengthy. It's at least a decade. And Kazakhstan has emerged since the mid-90s, has emerged as the dominant supplier of uranium in the world, around 42%, within Canada supplying the next 13%, Australia at 12%, and maybe 10%, Uzbekistan 6%, and then it dribbles off into small producers. And Kazakhstan has the ability to continue to increase supply through its in-situ recovery system, and it uses a different set of environmental standards than are required in the United States. And right now the U.S. government has said we are going to have this $100 million buying program per year to buy uranium from domestic sources for the stockpile. And it's not because they need uranium fuel for any of its power reactors. It's because there are international rules which forbid the sale of uranium to countries that might use it for weapons production. And of course, the United States makes nuclear bombs. So buying from Canada can be a bit problematic because Canada might refuse to sell to the United States, even though in practical reality, all the uranium America could ever want could come from the Athabasca Basin, and Canada, being an ally of the United States, is not going to not sell it to the United States, though they might be very reluctant to sell it to Iran. So but the market has jumped onto this, thinks it's significant. Companies have started buying spot uranium as a speculation, but that $100 million a year is a drop in the bucket and isn't really going to make much difference to the uranium price. So I think if we do not get something like fusion coming in by 2050, uranium-fueled nuclear energy will become an important part of the clean energy system, where natural gas and coal are no longer the primary source of electricity. But I think that time is way down the road. It is premature to get excited about uranium, but it is happening in the market, and that's an example of the irrationality you alluded to, where people are piling into this sector simply because they can come up with a futuristic story about it that may not be reflected in the fundamentals of the near-term moment.
What's more important to resource juniors involved in critical metals, geopolitical uncertainty or technological innovation?
Well, right now, there is a major showdown underway between autocracy and democracy as the political foundation of the world's nations. And China is the leader in autocracy, with Russia right behind China, and a number of countries like Poland and Hungary actively trying to also become autocracies. And even within the United States, there is an ongoing push to turn the United States into an autocracy. But insofar as countries like the United States and Europe remain defenders of democracy, there is a growing geopolitical conflict between autocratic nations like China and democratic nations like the United States. And this is relevant to the resource juniors because a lot of raw materials now come from places like China. And with the clean energy trend unfolding, creating new technologies that generate new demand for rare earths, for lithium, for these various metals that go into electric vehicles, this creates a problem because China is also engaged in this technological race, and its own resources are not infinite. And if the geopolitical tension rises to a point where, say, China says it's time for Taiwan to stop being a democracy, it's time to annex Taiwan and make it part of China's autocracy, then you will probably see the flow of rare earths or rare earth-based components from China cease. So this is very important for the resource sectors. It isn't relevant for gold, but it is for all these other materials. And China has made a lot of inroads into places like Africa, where the nations are run by corrupt autocrats, and so they can do their deals quite well and get their offtake agreements in place and secure their supplies. The United States has been sort of left on the sidelines. Globalization is in retreat. There is a push for diversification of supply, and this idea that there is one market price for any commodity, this is falling apart because there's going to be different prices for different regions depending on where you fall within the autocracy-democracy spectrum. But the innovation is very important to these more obscure metals, and these have small markets, sometimes only in the hundreds of millions of dollars, sometimes only $1 billion. It's not like the $90 billion copper market or $50 billion zinc and nickel markets where big players operate, and you need to find really big deposits to have your discovery turned into a mine. And this creates an opportunity for the juniors, both as a result of geopolitical supply disruption of materials such as rare earths, but also when new demand emerges for materials such as lithium, which have a better distribution around the world than, say, rare earths, where the concentration has been in China. So I think it's a toss-up. 10 years ago, globalization was everything. China was going to, be in a stable relationship with the United States. They had their hybrid central command entrepreneurial economy. But in the last decade, since Xi Jinping has taken over, it has become clear that China sees itself largely as a central command economy and intends to extend its reach well beyond its own borders and become a big power rival to the United States. Russia's still in the background causing trouble, but it just doesn't have the population base to really be a big player. Yes, it can come up with weapons and cause a lot of problems, but it's China with its giant mass of people squaring off against Europe and the United States. That's going to be a problem down the road. It's not clear how it will be resolved, but I think both of them, technological innovation, and especially even for copper, which is one of the biggest base metal markets in the world, electrifying all these the car fleet will use a lot more copper, building out the grid so that this power can be delivered to all these charging stations. All that's going to end up, at least at the local end, using up a lot of copper. So both geopolitical supply disruption risk and new innovation driven demand, they are both things that the juniors should be paying attention to, and both of them will positively impact the resource junior sectors that is looking for something other than gold.
What is ESG and why may it be important for resource juniors?
Well, ESG is the new buzzword that everybody is jumping on, even Wall Street. It stands for environment, social, and governance. And it's being applied across the board to all companies. But in the case of the resource sector, it's the environment part is quite easy. It's the mine that you're building. What is the environmental impact of that mine? What emissions are you going to inflict downstream on your surroundings? And in democracies where people can complain about stuff, unlike in China, where if you complain about something, you get put in jail, there you have rules being developed that prevent companies from building a mine that just dumps the emissions into the local water system and gives cancer to people downstream. And this has created something of an imbalance, an unfairness between democracies, advanced democracies, and autocracies like China, because their price is subsidized by the willingness to dump the costs onto downstream victims who have no ability to complain and put a stop to it. And there's been a conspiracy in the West to benefit from this by having a not-in-my-backyard type of policy where you oppose mining no matter how much you mitigate against environmental emissions. And so it's like, okay, I want my smartphone, I want my car and all that, and so long as the cheapness of it is due to bad stuff being done to the environment in Africa or Asia, I don't really care. But this is starting to change. And part of the whole environment equation is the carbon dioxide footprint of every product. Now, the social refers to how does the company treat its workers, but even beyond that, how does it affect the surrounding communities? Does a business help or harm other people? Is the company just harming others to benefit its shareholder group? And the governance, that's a bit of a more abstract thing. It's how transparent is the company in the way it runs its business, and that serves partly the common good. Like, does this company do business with corrupt dictators that allow it to mine a deposit and get title to it? And it also can do harm to shareholders by having a very short-term attitude. The governance issue is now forcing companies to take the long-term interest of the shareholders into account. And that means no more of this just-in-time reliance on supply chains that end up being disrupted and causing harm to the value of the company. And also the long-term viability. I mean, oil companies have substantial pension fund shareholders, and they're being asked, if we see this shift away from fossil fuel combustion, what are you doing to diversify your business so that we don't end up watching the value of our shares in this company diminish over time? So ESG is this new buzzword that's driving fund managers in their decisions for allocating capital. And it's becoming relevant for the juniors because companies or investors are starting to ask, what is your carbon footprint? What is your impact on the environment? And this will contribute to the diversification of a metal pricing system through these smarter market technologies where you can create auction systems and upload your 5 tons of material and attach ESG credits to it. companies, end users can purchase this, and it's all documented. And then they can add up and say that my Tesla's carbon footprint from all its input is this number. And it's verifiable, because greenwashing has been the BS that all these companies have engaged in the past decade to pretend that they're actually doing something about ESG stuff, but there's been no way to verify it. So technology is making it possible to force the company to say, prove it, that your carbon footprint is only so much. And this is important to the resource juniors, because many of these smaller deposits that they are able to get hold of to discover and push through the feasibility demonstration cycle, they may not be as profitable as a big giant deposit somewhere in Africa, but it can come with high ESG credits that can be documented, and the end users, when they pay up for this, they can demonstrate to their consumers that, yeah, this is the carbon footprint for this, is our product is lower than that of our competitors. And this also opens up the way for this conflict between the 99% and the 1%, where the wealth is concentrated in this small group of people who have way more wealth than they can possibly choose to spend. When you can actually make purchases based on ESG ratings, then you can justify paying extra, and you're not just a sucker buying some greenwash BS. And the United Nations has said that, all the processes in place right now really aren't going to deliver that 1.5 to 2 degree temperature increase limitation by 2050. There's a gap in there, and they pointed out that the 1% consumes, their carbon footprint is as big as that of the bottom 50% of the world's population. And if they were able to reduce it to 3% of their current carbon footprint, they could end up making up this gap. So there's this personal decision opportunity for the 1%ers to start focusing and demanding on ESG credits as a personal way of making a difference that doesn't dump the sacrifices of higher costs on the 99%ers until farther down the road, when all this ESG pressure ends up creating that technology innovation that takes, say, solar panels for your roof from something that wealthy people did just because to something that now any person is justified in doing because the cost has come down so much as a result of these initial investments. So ESG is a very big term. It will create markets, premium markets for deposits that juniors find that are in safer jurisdictions where there are environmental rules that make the cost of production higher than in other jurisdictions. I think it's going to be a big plus for the resource junior sector.
Assuming the current trend for higher metal prices outside of gold and silver is sustainable, should this lead to new discoveries by juniors?
In the sort of base metal markets for copper and zinc, it's all about very large deposits, and there are regions of the world that have been inaccessible and remote, where it's very difficult for the juniors to get into, and where often the title systems are kind of sketchy. And in jurisdictions like Canada and the United States and even large parts of South America and obviously Australia, the surface has been picked over pretty well. So big deposits are very difficult to find by just prospecting. So this means looking deeper, looking undercover, using new technologies, using sophisticated spectral analysis to look at subtle alteration, anomalies over vast areas to tell you something was going on deeper. But it still requires a drill, scout drilling, to find out what the geology in the third dimension looks like, and that's very expensive. We're not yet there. But if I'm right that we're in a 5 to 10 year resource sector boom, more and more capital will come in, and companies that develop sophisticated theories and targeting methods, assemble targeting methods for areas will get the capital to do this early stage prospecting in the third dimension that could lead to major discoveries, world-class discoveries that haven't really been happening in the past decade, which has been hampered by the decade-long bear market that we have had in the resource sector. And of course, higher prices, metal prices, create the impetus to look for more of this material. In the precious metal sector and in the critical metal sectors, the deposits are going to be smaller, and the juniors are going to be the main engine for discovery in this area. The bigger gold producers are going to buy out a junior that finds a large gold deposit. And with high-value metals, you don't need a super large deposit to end up having a world-class score. So the higher trending metal prices, similar to what happened during the China super cycle of the first decade of this century, will drive exploration. And unlike that China super cycle, the money went into juniors that managed to find the failures of past exploration cycles in the 70s and 80s and 90s and 60s, deposits that were discovered that didn't work at the real metal prices from those decades. But when China came along, it was a order of magnitude of new demand, which increased the real price, and it dragged those deposits into the money. Yes, these are still sitting there. Many of them were bought out by the majors. They will look at developing them as we get stronger metal prices. And there may be a few still for the juniors to find and get hold of and do a big song and dance about. But the game's going to be more finding evidence of a system that hasn't yet been delineated. So either total grassroots exploration, which may take a couple of years before the money and the enthusiasm for that is there, but more likely focusing on existing systems where something was found and put new models, new technology to work, and extra capital to chase it deeper or sideways to show that this is the tentacle of an octopus that was not properly understood back in prior decades.
What is the future for gold and silver juniors?
Now, Bitcoin may come and go. It could suddenly fall out of vogue. Everybody sells it. The miners start losing money like they did a few years ago when the price collapsed. But gold is going to be around for at least another century as an asset class that people value. And as the global economy grows bigger and bigger, the gold stock value will have to go up. And it's now the 6 billion ounces that exist. There's only about 90 to 100 million new ounces being added per year. So as we come out of this COVID recession and the global economy starts getting back on track, and say we even get this roaring 20s boom with a lot of new innovation driving an optimistic perception of the future, the amount of money people will want to park in gold just in case everything does blow up, it's going to grow faster than the mine supply. And this means an uptrend for the gold price. And even here at $1,700, this is great. This is a 35% real gain over gold from $400 in 1980, inflation adjusted to the present. The market's still too much obsessed with what is the current trend in gold. Is it up or down? If it's down, oh, we hate gold. We want to dump our gold juniors. Oh, it's up. Okay, let's pile into it. No, we need to just ignore these local fluctuations in gold, accept that in the medium term, the price of gold will make it through $2,000 and keep going, and then just focus on, is the grade that we're getting good enough for the price that we have right now? And as for the case, silver has its stackers and hoarders, but silver is used industrially. Most of the silver above ground silver stock is actually busy doing something useful, and the silver demand will track the growth of the economy, and silver can become part of all this electrification trend that we're seeing unfold over the next 20 years. So gold and silver will continue to be very important for the juniors, especially because smaller scale mines are possible for gold and silver in a way that they aren't for bigger metals like copper, iron, and zinc. Nickel's also interesting because it has a higher price, and the grades in a good deposit can be quite good, and because they're relatively small deposits, there's still plenty of opportunity to make very interesting nickel discoveries. And where there's nickel, there's usually the platinum group metals also to be found. And platinum has been in the doghouse, but if hydrogen fuel cells end up becoming a dominant form of the electric vehicle rather than lithium-ion batteries, there's not enough platinum around for that. Palladium is in shortage right now because, gasoline-powered cars aren't going away for the next, 10 years. And with the revulsion against diesel, which relied on platinum, and the shift to more conventional gasoline cars, that requires palladium for the pollution control. So palladium's got a very strong price right now, and that's also something that the juniors can look at because the palladium tends to be dominant in deposits outside of South Africa, where the ratio of platinum to palladium is dominant.
Are you buying any junior sectors now?
Well, we can look at in terms of location and metal, target metal. In terms of location, I think the COVID vaccine rollout in places like the United States and hopefully Canada will get things back to normal and allow exploration to be done in an efficient manner. But in places like Brazil, where we're now seeing that people who had COVID last year are getting sick with COVID again because of the new mutation, I think it may be a while before these places in Latin America properly open up and make it easy to do exploration. So jurisdictionally, I'm now particularly focused on Canada, to some degree in the United States. We have to see what the Department of Interior does with their new head, Deb Haaland, who is the first Native American to ever head up the organization. Is this going to make drill permitting worse than it has been, and sort of stop a trend of back to America for exploration to find these deposits in America and make America less dependent on other jurisdictions that are shifting to autocracy type political systems? So Canada, to some degree, the United States. In Canada, the British Columbia is a great place to explore. Quebec and Ontario also. Saskatchewan, Manitoba, Alberta doesn't really have much in terms of mineral potential. And Atlantic Canada is also interesting. And in the United States, Nevada and Arizona are the places that intrigue me the most. And in terms of metals, I think some of the critical metals like rare earths, Rare Earth Mania 2.0 is coming. The prices are not going to go as insane as they did in 2010, 11, but they are going to end up higher. And if this geopolitical disruption and emphasis on ESG credentials, and China cannot possibly deliver any credible ESG credentials because it has no democratic system for allowing criticism of what goes on in the country, we may see a preferential pricing emerge for rare earth deposits in North America that end up being developed with offtake agreements based on ESG type thinking, which is becoming more and more legitimate thanks to the investors insisting on ESG being part of a company's operating policy. And of nickel I'm interested in, and of course I'm always interested in gold. Silver, not so much, because silver is generally a byproduct. Not that many deposits have silver as the dominant metal. But if you find one where silver is the biggest credit, such as a Broken Hill style deposit, well, then I'm interested in those also. So Canada, United States, Australia also. Australia has enormous potential. It has a culture supporting exploration. And that's right now the regions that I'm particularly interested in. And I'm kind of interested across the board in all the metals. Lithium, not so much, because I think that will end up being dominated by a few players. But other things like niobium, you find a good niobium deposit, that will interest me. And that's it. I think the whole sector in general will do well, but geographically you have to be selective. Scandinavia, I should throw into, is also a good reason because of its history of mining to be looking for new deposits by the juniors.
Any words of wisdom for people who like the junior markets?
The thing to worry about is momentum. And what I'm seeing is capital flow into some stock. It trades 30, 40 million shares a day and doubles in price, sometimes goes up more, all on the basis of one result. And the key is, what is the context for this news? Does this intersection tell you something about a big tonnage footprint that's starting to unfold, or have you simply re-drilled a known vein that has no real size potential? And the best I can say is get educated and look at the geological context of the project, the target that's generating the excitement, and ask yourself, what is it that you can already see there in terms of potential? And if the valuation is way beyond what you can see, don't just walk away, run away.
John, thank you so much for being on This Week in Money.
You're welcome, Jim.
My guest has been John Kaiser, the founder of KaiserResearch.com. He's a regular guest on HowStreet.com radio with his weekly show, Discovery Watch. Coming up, Victor Adair, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair, just retired from nearly 50 years of being in the brokerage business in BC. His website, victoradair.ca. Welcome back to This Week in Money, Victor.
Thank you, Jimmy. Good to be with you.
Victor, the major European and North American stock indices hit new all-time highs again this week as the Federal Reserve confirmed that they would remain very accommodating for at least the next 2 years. Millions of Americans are receiving stimulus checks, and the rollout of the vaccination program in the U.S. seems to be going gangbusters. Before we discuss individual markets, what's your current big picture view on all this?
Well, Jim, I'll tell you what. I'm just writing my blog that I'll hopefully get posted later today, and I'm starting it with a question. Peak stimulus? You know, it's sort of is this as good as it gets? I mean, we just see, it seems like every week, you know, we have new all-time highs in the stock indices, and Canada is right there with the Americans and certainly some of the leading European indices as well. Yeah, you know, I mean, the Fed, what did folks expect the Fed was going to say? I mean, they just sort of put their foot down and said they're going to remain really accommodative until there is full employment and until, you know, inflation is well over 2%. And there you go. And in a way that was music to the ears of the runaway markets, the commodity markets and the stock market certainly, and prices went higher. I'm thinking it may be one of those buy the rumor and sell the news kind of events, because the stock markets popped and the U.S. dollar fell as the Fed made their announcements, and then the press conference a half an hour later sort of just fleshed it all out. 24 hours later, it was a different story. And then, of course, that was Thursday, 24 hours later. And Thursday was also the day that crude oil took a big skid. The stock market was selling off. The bond market was selling off. And, you know, we get these runs in the market. And I have to quote my good friend Bob Hoy, who I know is a regular guest on your show. And I've known Bobby for so long. But I was talking to him on the phone the other day, and I was reminding him that years and years ago I'd heard him say that people will believe the most preposterous stories so long as prices keep going up. And I kind of think that's the sort of condition we're in right now in the market. One of the charts I'm going to put up on my blog today is a chart going back at least 40 years on the S&P. And you shrink the chart up and you look at it and keep it simple. And it almost takes your breath away as to where we are now compared to where the market was then. And I just think we are at risk, let's say, of a correction. And that's kind of my big picture view here, and that would apply to anything, you know, that's been bid aggressively higher. I was talking to my friend Mike Campbell the other day, and he was telling me about baseball cards. I had no idea. You know, I live a quiet life, but baseball cards have been going to the moon. And then there's these new things, NFTs or whatever they are, you know, digital art that people are falling all over themselves to buy. These are symptoms, in my view, of a market that is just giddy with the prospect of getting rich quickly. And, you know, I don't want to just sound like an old sourpuss, but, you know, I've seen this movie before. And it may well be that the market doubles from here. Who knows? But you know, I just hate losing money, and I tell you what, it is way easier to lose money than it is to make money. So that's kind of where I think we're at in the big picture, and you know, we can kind of talk about the individual markets and maybe I can flesh it out. But certainly, with all these things going on, the stimulus from Biden, the checks are going out there. The vaccine, they've now vaccinated, I think, 100 million Americans, and they're on pace to have, you know, 200 million done by the end of April or something like that. That's going very well. It just seems like everything is, you know, perfect, and that's when guys like me start to get suspicious that maybe things, as Bobby Hoy would say, maybe things are just a little bit too preposterous here, and people are a little bit too gullible.
Sure, I remember the sports card mania of the 90s. Every corner store was selling them for outrageous prices. Shops popped up everywhere, and they all eventually disappeared. Is the same thing going to happen with these non-fungible tokens that they're doing with digital art? Why would I want to pay $2.5 million for somebody to just hit the delete button and disappear it?
I know what you mean, Jimmy, and it may be that I just don't understand the new world, you know, like I'm yesterday's man and that sort of thing, but I'm looking at the psychology. I've seen this before. I mean, I think in the current environment here, you know, if I could be a little coarse, I would say people don't want no lousy 15% annual return. Hell, you know, they want to get rich quick. That's the mood. So, as I say, it may carry on, but we may have also just had an important turn here this week in psychology across markets.
The NASDAQ index outperformed the S&P and Dow Jones for nearly 20 years. Last year, again, the NASDAQ was the big performer, but it's been weak this year. Why is it?
Yeah, one of the real action, I guess, in the stock market has been rotation. In other words, the things that were hot yesterday are shunned today, and there's the new kid on the block is getting bid, okay? You look at one of my favorite sentiment indicators is Tesla. I mean, Tesla peaked out in early February or something, and is, you know, it's just not as sexy, you know, as it was before. Part of the rotation is to go from the working from home environment to the reopening environment. There's that. I think there's another rotation where what we would call value stocks are being bid, where growth stocks are being sold. And the long-term charts that I've put up in my website here over the past couple of weeks, people can go and have a look at them there, that show what has happened, the relationship between value and growth. I mean, growth has just clobbered value stocks for a long time. And the last time we had a real big change in that, interestingly enough, was back at the end of the dot-com boom. And if you probably do remember, in the very late 1990s, everything that had .com in its name just, rocketed higher, and everything else was left at the side of the road. When the .com boom peaked and turned lower in the spring of 2000, then all of a sudden, growth stocks looked good. So there's just this rotation, and there was a beautiful interview, and I did post a link to that in last week's blog, by Stan Druckenmiller, where he talks about the inside of the stock market. And he said the inside of the stock market, that's the different sectors and how they relate one to the other, is the best economist that he's ever seen in terms of predicting, where the economy is going and where the market goes. So I think it's been all about rotation, or in a colloquial sense, it's, yesterday's hero is a bum today, and there's a new kid on the block that everybody is falling all over. So, yeah, we're getting this change from the changing of the guard. Maybe is another cliche, something like that.
Bond yields in Canada and the U.S. have been rising sharply this year. Is that because of increasing inflation expectations?
Well, let's put some numbers on it. Last year in August, the low, I guess like the all-time low for 10-year Treasury yields was about 0.5%. The current yield is about 1.75%, so it's had quite a sharp increase. But why has it happened? I mean, well, we got to the ultra-low rates at a period of time where the bond market was very fearful that we were going to struggle with the virus. And the Fed had gone great guns to push interest rates down to zero, and were buying them like they were going out of style. And, since then, in a way, we've had some optimism come back into the market that maybe we're not all going to die as a result of the virus, and the economies will survive. The reopening, as I referred to a moment or two ago. And there certainly has been an expectation that there will be inflation. And I'll tell you, I think, let's make this point. There's different time frames, and traders and investors really have to pay attention that they don't get mixed up on time frames in terms of, on the one hand, they get a time frame for their analysis, and another, they get a time frame for their trading. And believe me, I can do it regularly. It's easy to do. The classic would be some guy who buys something because he knows it's going to the moon really quickly, and 3 years later he still owns it, and it's kind of hidden in his RSP someplace because it didn't go to the moon immediately, and it's now worth a fraction of what it used to be. So you can get mixed up on time frames. But very short term here, I think there's almost a hysteria in the market about the looming inflation, and I think that bubble. This is my guess as a trader, and believe me, I'm willing to be wrong, but I think that bubble might have got popped this week. And the action that we saw in crude oil, for instance, or the stock market here, which it lurched higher immediately on the Fed news, and then 24 hours later it was sharply lower. We may have had a popping of that inflation expectation bubble. I'd say also that the speed with which the bond market fell, and that was increasing speed. It started to fall from last August highs on bond prices. And as we started this year, the pace of the decline really picked up. And that looked to me like what I'd call get me out orders, where people who own bonds are going, oh my God, what am I doing with this stuff? Call a broker, get rid of this stuff, sell it. I don't care, hit the bid, whatever it is, that kind of selling. So I think we're in a condition here right now with the bond market where if, for some reason, the stock market was to start to roll over, the bonds being very oversold here in the short term, I think would get bid. But, on a longer term time frame, I'm kind of sympathetic to the inflation argument. I think one of the reasons people are doing what they're doing, like bidding up the real estate market all over North America, residential real estate, red hot. I think people somehow in their own way understand that the authorities, that's the government in collusion with the central banks, are printing a lot of money. And, there's no plan to have a balanced budget. The MMT theory, you just keep printing the money until, inflation starts. Well, inflation is, I think, going to front run that, and that's one of the reasons people are putting their money into real things. I mean, picture this, Jimmy. Let's say you had $100,000 in cash and you got it in a box. Now, do you want to take that and hide it away someplace? Or do you want to swap that and hide away a bar of gold or a bar of copper or, bag of sugar or something like that, or a down payment on a house? And people are going, that's an easy question to answer. So I think there's a number of reasons here why the bond yields are rising. But just to put it in a perspective, those were like all-time forever since the Romans ran the world, lows that we hit last August. And where we are now at 175, just a few years ago, that would have been considered astonishingly cheap for a yield on a bond.
WTI crude oil prices essentially doubled from November to last week's high of $68, but yesterday crude tumbled nearly $7. Has the WTI bull market been gelded?
We are getting casual. Well, it was astonishing. The rally from last November and the beginning of November, just before actually the election happened on the 3rd of November, a number of markets changed direction, and certainly one of them that has run so strong has been the crude oil market. I will tell you that last year, call it the fossil fuel energy sector, was the absolute dog of all of the sectors that are out there. If you could be in tech or healthcare or, staples or whatever, heavy equipment. Energy was the dog. Now, year to date, it's been the new kid on the block. It's, this is that kind of that rotation stuff that I was talking about earlier. So it's been a double in WTI. And while at the same time that was happening, the forward prices, in other words, you got the price for crude oil for delivery today, a month from now, a year from now, 5 years from now, the forward prices were way lower than what the market was bidding up the front end of the curve. And it would seem to me that speculators were in there. There was, people as a crowd, they will embrace a story. And the story has been, inflation is coming. Once we reopen the economies, there is going to be an imbalance between the supply and the demand on energy, and prices will go to the moon. So, the market got bid higher. I think, again, the speed with which the crude oil market reversed on Thursday after touching what was, I think, a 28-month high on front-month WTI was pretty astonishing. We kind of again, get-me-out orders. There'd been maybe a lot of speculators in there that thought it was a layup trade, and suddenly, they get margin calls. So is the WTI bull market over, you ask? Well, again, time frame, I think it's been wounded here. I can imagine, that we will have higher prices on an inflationary basis going forward, but there's been a lot of inflation assumptions built into the market that got us up to $68. Let me put this in perspective. I remember back in 2008, July, WTI hit $147 a barrel. And there were some economists, and one guy in particular, famous chief economist, one of the leading Canadian banks, who was pounding the table that we were going to see $200 or $300 WTI. Unfortunately, 5 months later, it was $30 because, the nastiness of the fall of 2008 hit. So, I can make guesses as to where something might be at 6 months in the future or a year in the future, but it's almost like it's entertainment. It's coffee table, or what do they call it, cocktail party chatter. There's so many things can happen. You've got no idea what's going to happen. So my trading is pretty much short term. I kind of focus on what I can see, and by that I'm talking about market psychology as much as anything. So WTI, has had this fall. It'll be interesting to see if, in fact, this week was a pivot, not only in the stock market, but also in commodities. I mean, the whole commodity complex has had a very strong flow of capital come in here. And I mean, I was writing a piece last December about, hey, commodities look like a hell of a deal. And, well, indeed they were. It's been quite a run. I'm not patting myself on the back. The point I want to make more is that commodities have become very popular very fast, and prices have reacted accordingly. So we might have got a little ahead of ourselves here. And if the bull market's going to continue, my thinking has been, since I wrote that piece in December, was, buy them on a good correction, and $7 is not a good correction in my book.
In January and February, you told us U.S. dollar index made a significant low in early January and looked to be headed higher. Do you still feel that way?
I do, Jimmy, and part of who I am and the way I look at markets is I'm ornery. Okay, I want to be a contrarian. Everybody thinks being a contrarian is kind of sexy. Actually, it's not a very pleasant spot. But yeah, I did say that January the 6th was the day all those people attacked the Capitol building in Washington, D.C. I watched it on television. I thought, oh, my God, look at this. The world is seeing this. The rabble are desecrating the house on the hill. Being dramatic, but the world kind of looks as America. A lot of the world anyway looks at America as being a bastion of free enterprise and liberty and so on and so on. And to see that happening, the next day I bought the U.S. dollar because overnight I was thinking about it. Thought this is a classic inflection point, and it turned out it was so far. But the currency market has not been monolithic. The strength of the U.S. dollar has been mostly against the European currencies, and by that I would mean the euro in particular, the Swiss franc, the British pound, the Scandinavian currencies, and so on, and also the Japanese yen. While the commodity currencies, which could be, let's say, Canada, Australia, New Zealand, and you could add in some others like Russia or Norway or whatever, they've done better. So yeah, the U.S. dollar did make a turn there. It's at that point in time, the market was heavily short of the U.S. dollar. The U.S. dollar had been trending lower since March of last year, so kind of made sense to be short. As the market develops momentum in one direction, more and more people get on, and the more it goes in that direction, they say, gee whiz, let's get some more, and they add to it. So at the turn of the year, and just as a segue there, you go back and look at charts over the last 40 or 50 years when we've had freely trading currencies, and it's amazing how many times the U.S. dollar makes an important turn right around the end or the beginning of a year. So anyway, the U.S. dollar made that low with the consensus very bearish on the U.S. dollar. It was not a popular or a common view to say, hey, I think the U.S. dollar is going higher. And a lot of the people that were bearish of the U.S. dollar had a lot of good reasons. Some of the classic old school metrics about why the U.S. dollar was awful. But in the foreign exchange game, it's one currency against another. So you could have one that's awful and another one that's more awful, and the one that's just plain awful, goes up relative to the other one. So, yeah, the central bank all over the world, they're printing dollars and pounds and pesos and everything else and devaluing the currencies. But when you're measuring currencies against other currencies, I like the U.S. dollar.
The Canadian dollar hit a 4-year low around 68 cents last March and has rallied over 12 cents since then, hitting a 3-year high this week. What are your expectations for the Canuck buck?
Okay, I could do this. I sold the Canadian dollar on Thursday. And, I may regret it next week. I mean, that's what trading is. but it hit a 3-year high, and it's as I said, the Canadian and the Australian and the New Zealand, the commodity currencies have been strong against the U.S. dollar, while other currencies like, for instance, the Japanese yen and the Swiss franc are thought of as safe havens. Well, those two currencies have been taken up behind the barn and shot this year. I mean, nobody is interested in safe havens because the environment here is, hey, it's easy to make money. You don't need to hedge your risk. You just buy stuff that's going up, and when that goes your way, buy more. So the Canadian dollar and the Australian dollar and the New Zealand dollar were part of the things that got bid up. They're part of the reopening play, the inflation play, and the Canadian dollar, as we've talked about on this show before. There's, over the years, there's three main things that affect the value of the Canadian dollar. One is how the U.S. dollar is doing against currencies generally. So if the U.S. dollar is strong like Big Bull, Canada's probably in a downtrend against the U.S. dollar. There is commodities, and you look at a long-term chart, and again, I put these charts up on my website. The correlation between the Canadian dollar and the major commodity indices since, let's say the last 20 years especially, has been very strong. Commodities up, Canada up. Commodities down, Canada down. And that's how it's been. And certainly the interest rate differential is often a function. If Canada, for instance, was to have interest rates that were lower than the United States, capital would flood out of Canada and go to the States. There's going to be some of that. But where I think Canada goes from here, short term, I sold it on Thursday because I saw crude oil coming off and I saw the stock market coming off. And I was just wondering, I forgot the third correlation there. In the last 2 years or so, almost on an hour-to-hour basis, as I watch my quote boards closely, Canada moves up and down with the S&P 500. Canada is a risk-on or a risk-off play in harmony with what the stock market is doing. So when I'm looking at the stock market coming down Thursday after making new all-time highs, either Wednesday or Thursday morning, crude oil coming off, the U.S. dollar is okay to maybe a little stronger against most other currencies. In Canada, to me, it's sticking out like a sore thumb. So sold to you, and we'll see what happens from here. Now, over the next couple of years, I think, I can imagine that we can have a commodity bull market. Commodities have been and still are relatively cheap compared to stocks, and I think we could see some capital go into the commodity market. But I think the market's been on that here for the past year, and Canada has had that 12-cent rally. So we may need to see a correction before we go higher in Canada, and that's, I guess, what I'm playing now by selling it yesterday.
When you read about gold on your weekly blog, you frequently point to the gold ETF market having a significant impact on the price. Is that still the case? And now that gold is down about $300 from its all-time high, are you a buyer?
I'll answer that. Yeah, I bought gold this week. I haven't bought gold I haven't been on the long side of gold for a while. And gold had a pop on the Fed being easier than expected. Let's call it that. I think we jumped up about $20 or $30 or something, and didn't hold it, so I sold the position. It was just meant to be a short-term trade. But I don't want to be short gold here. I know it's come down the way it has. Oh, sorry, Jimmy, I should answer your question on the ETFs. Yeah, I've talked about the ETFs before. Let me make it simple. Beginning in March of last year, when the market was just freaking out because of what was happening with the virus, and then the Fed came in huge, and the stimulus programs were born and so on. Between the lows in March, when gold was about $1,500, and then we rallied over $500. Between March and October, there was about 800 tons of gold bought in the global ETF market. That was the buying that took the gold market up. Now you could say, well, the people that bought gold ETFs had a reason to do that. Yeah, of course. But that's where the buying happened. Where the buying didn't happen during that same period of time was in the major retail markets in China and India that they just shut down. So the gold market really needed that ETF buying, and it took prices up to all-time highs. Beginning in November of last year until, just last week, we've seen 300 tons of that gold sold. So 880 odd tons bought, 300 tons sold. So about a third of the gold that got bought has been sold since November. And that's kind of contributed to prices coming down from around $2,000 an ounce to around $1,700 an ounce. So the gold, the buying and selling of the gold in the ETF market, I think, has been a real big deal for the gold market. I think gold has been, I described it a couple of weeks ago as a puzzle when I was writing about it in my blog. You kind of would think that with inflation expectations rising the way they are and manifest as they are in the other markets, that gold would have done better. I do know that gold historically is highly negatively correlated to the U.S. dollar. In other words, U.S. dollar up, gold down, and vice versa. And certainly in the past few years, certainly since 2018, gold has been very correlated with, call it real interest rates. And with real interest rates negative, that's a wonderful environment for gold generally. So we've had the interest rate market. Clearly, rates have been going up, nominal rates as well as real rates, although real rates are still negative. So that's not been a good environment for gold to have a U.S. dollar kind of inching higher and interest rates kind of inching higher. That's not good for gold. But I think what's really happened is that gold had its time to shine, and there was a rotation a bit. We had a spectacular run to new all-time highs, and then it's backed off. We ran up $500 and we backed off $300, something like that. And gold's been out of favor. People would rather buy something that's going up than something that's going down. I think what'll get a bid in the gold market is if there's some fear in the market. The market gets uncertain or worried about things or gets fearful, and prices of other things start falling, like if the stock market starts coming down and the prices of baseball cards goes no bid, you might see gold, at least relative to those other things, start to rise. So I don't want to be short gold here. I'm kind of on my list of things to buy. I'm looking for a setup in gold, and I'd be a buyer rather than a seller, but right at the moment, I'm flat.
In your blog last week, you wrote, it is essential for traders to forgive themselves for making mistakes or missing a good trade. You said people who could not forgive themselves should get the hell out of that business. Would you like to expand on that idea?
Sure. Just before we started to tape this interview, we were talking about another person that you've interviewed many times over the years, and I've known for years, and he was letting you know that some people had been giving him some grief because maybe something that he'd recommended hadn't gone up or blah, blah, blah. You have to have a thick skin, I guess, to be in a business where you're recommending things to people. I don't do that. I was a broker for years, and I think I did a good job of that. And these days, I just trade my own accounts. And I am, my personality is, I do like to do things really well. If I take up something like golf, I just drive myself crazy practicing at it to be really good at it. And I certainly had an expectation that I would be really good as a commodity trader, given that I've done it for 50 years. But you can never be perfect. Let me give you here's a great test for people that are listening. Here's a way to know whether or not you should try it. If you're thinking about being a trader, listen to this test. So here's the situation. You buy 100 shares of a stock at $100 a share. Okay, you spend $10,000. Well, by gosh, the stock goes up. It's now worth $500 a share. Your position is now worth $50,000. and you're pretty happy about that. But, then it starts to drift off, and, you kind of talk to so-and-so, and everybody says, oh, no, don't worry about a thing. It's going back up, and so it drifts off and drifts off. So finally, you get out of it at $200 a share. The stuff you paid $10,000 for, you sell it for $20,000. Now, do you think you made $10,000 or you lost $30,000? And if you really believe you lost $30,000 because you didn't sell it when it was $500 a share, you should not try to make a living as a trader, because you'll just drive yourself crazy. You never sell the high tick. You never buy the low tick. You make mistakes. You buy stuff and you go, oh, I can't believe I did that. I hit the wrong button. I got the wrong symbol or whatever. All of that kind of stuff. I think trading, somehow folks figure, and these days I think nobody, as I said, wants to make 15% a year. They want to get rich quick. They're looking for somebody to tell them what to buy that's going to go up 100-fold. And of course, the marketing guys all know that, and that's the kind of bullshit they're telling people. Buy this. I just absolutely know it's going to the moon, and people will. And that's that thing I said about Bob Hoy. People will believe the most preposterous stories so long as the prices, keep going up. So being able to, if you want to trade, and that's what you do for a living, you just have to be aware that you're going to make lots of mistakes, you're going to get stuff wrong, and you're going to miss trades. I mean, my gosh, the trades that I sort of just missed, I was looking for that, and I couldn't bring myself to buy it because the price started to go up too far and all that. It's brutal that way. And somehow at the end of the day, I know a friend of mine said that he never counts his what we call open trade equity. In other words, this test, if he'd have bought the 100 shares and he sold them for $200, he'd say, hey, that was a good trade, and he'd just move on to the next trade. But some guys I know will just beat their head against a wall because they just believe they should have sold those shares at $500. So if that's who you are, dabble in the market, but don't try to make a living at it.
Yeah, don't go into broadcasting either. You should see the emails we get.
Well, Jimmy, that's how it goes.
Thank you, Victor, for being on This Week in Money.
Well, it's always fun talking to you, Jimmy. Let's do it again sometime.
My guest has been Victor Adair, just retired from nearly 50 years of being in the brokerage business in BC. His website, victoradair.ca. Our conversation took place on Friday, March 19th. And that wraps up our show for today. We'd like to thank our guests, Ross Clark, John Kaiser, and Victor Adair, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Larry, welcome back to Company Showcase.
Thanks, Jim. It's always great to be on the showcase.
Larry, EVs, battery plants, recycling, they're all hitting the headlines over the past week. Is that good news for American Manganese?
Oh, that's excellent news, Jim, especially when it comes to the recycling. We've seen announcements of gigafactories going in. We've seen the battery manufacturers building up to those gigafactories. We see actual suppliers that supply the cathode materials are getting much larger. And now recycling is being talked about, and certainly that puts us in a good position because we've strived hard to develop a process that is, let's put it up this way, right up to date on what the battery manufacturers are looking for. and but it also covers off, which is going to become very important here, probably this year, is just how much do you recycle and what goes back into the environment. And in our particular case, it's a closed loop. We don't put anything back into the environment that we can't. There might be some plastics or something like that, fluorites, that we capture before we put the powder out. But so we're in a good position. If you want to get a permit, perhaps a year or two from now, unless you can show excellent circular economy results, I don't think you'll get a permit anymore. So we want to be in that position to get the permits, and we spent a lot of money to get here, and a lot of time, and a lot of work. And thanks to the third tier work that we did, we found out about the particle sizes, which we'd never have found out about if we hadn't done that type of work. And and now we're closing in on that technology. We're doing work on the pilot plant and processing through the catalyst, to get the particle size down and the shape. So I think we're in excellent shape here. I'm seeing numbers of $8 billion worth of recycling going through 3-4 years from now, and that leaves room for everybody. And what is most astounding is the fact that all of a sudden there's a lot of companies that are interested in recycling. There's only so many methods that you can use. Thank God we got our permits and I should say our patents. And that was one of the critical things that we had to get done, right at the very beginning. So that's working out well in our favor. And if you want to put a plant in New York or Syracuse or Ontario or Ottawa, wherever, you're going to have to be making sure that you're not contaminating the environment or putting anything into the atmosphere. So that's what we've strived for, and now I think we've positioned ourselves in a position where we can actually, I don't see anybody else showing their powder. I don't see anything but round numbers when it comes to recycling, and you're not sure whether they're talking about the entire battery or if they're only talking about the cathode materials. But if they're not showing their powder, that means that they're probably talking about, the lesser methods of shredding batteries. And now there's a lot of companies out there in the shredding business that try to optimize that part of their business by creating, shredding machines that can do a lot of that work for you. And so you can just about buy it off the shelf. And, that's certainly we're looking at scraps, which is the low-hanging fruit, and we can go from there. And not to sound like I'm repeating myself, but I just walked through the door, and there have been meetings down at Cometco all morning and early afternoon. So I'm only talking about something that I know something about, and we don't have any press releases this week, but there's a lot of things pending that will be press releasable, and so we'll be working on getting those out. We need an odd thing here or there, so it didn't accommodate getting the press release out this week, which I know people are used to. But you got to cut us a little slack. We can't put a press release out every week. That doesn't make sense, and we don't want to put anything out that's nonsense. That really is nonsense. So it's a great time. I know that our market has suffered a little bit, but I'm certainly not concerned about that in the short term. I think that's a short-term result, and when we get back on track again next week, could bring in some advancements that the market's been waiting for. So we're just trucking along here, Jim, and trying to get everything done. And, when you start looking at $8 billion in say 3, 4, 5 years, what's it going to be like 10 years from now? It'll probably be more like about $25, $30 billion. So there's room for everybody. And remember that the more people talking about recycling, the more people that will, discover us. And so that's a good thing. I mean, I've been in this type of a market before, and until we got a certain critical mass of people that were talking about the process or the type of deposit you have or critical metals or whatever it may be, the better off everybody is, because now there's a lot of people start to focus on it. So I see this being a great thing, Jim.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metals company that had discovered a process back in 2010-11, and it was patented in 2012 for treatment of low-grade manganese, which is a critical metal. And we're doing work for the old Department of Defense and the DLA. So that's moving along. We took that process, and that's a cornerstone of our recycling, which is the way we process the material. So we've got that locked up tight, and now we're in the final stages of our pilot plant with the sizing of the particles. So it's the roots of our company, and we've got 4 patents around the world on manganese. We've got 7 applications in for other parts of the world for permitting, getting our patents in certain jurisdictions. So we're in good shape that way. You can find out anything you want at AmericanManganeseInc.com. You can contact me at my email address, LREAUGH@AMYMN.com. Or phone me at 778-574-4444 and get an update. I get a lot of queries in the emails. Sometimes it's quite tasking to get back to everybody, and sometimes you lose it and you don't get it. Just resend it. We are traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the QB board in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM.
Larry, thank you so much for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 19th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.